Hi, everybody. My name is Mark Buchanan. I'm a managing director at Stout, and I head up the firm's ESOP investment banking practice. It's really great to be with you all here today, and I want to give a special shout out to the folks at Rutgers for putting together this employee ownership symposium. I really do think it drives awareness in the marketplace of opportunities with employee ownership, and specifically in the case of what I'm going to talk about here today, drives awareness of opportunities with employee-owned companies themselves. So I've personally seen fantastic wealth creation occur within the employee-owned model. I've had the good occasion of working with some of the nation's largest and most successful employee-owned companies, and I can tell you that aligning the interest of the shareholders and the day-to-day workers definitely works out in the best interest of all stakeholders of the firm. Just in terms of my background, real briefly, I've been a banker for about 23 years. I spent the last decade focusing in on family, founder, and employee owned companies. And really, the hallmark of my practice is helping ESOPs stay in the employee ownership model. And I stress ESOPs staying in employee ownership because it isn't always the case that having an ESOP plan, the ERISA governed structure that exists out there, that's not always the right answer for companies, but I do believe that employee ownership is almost always the right answer, at least in some form. So what I'm going to talk about today, is a real life case study of private capital coming in next to an ESOP to support the mission and the values and the growth objectives of the employee-owned company. And what I can tell you is most employee-owned companies, as they mature and if they're successful, especially, end up facing, significant repurchase obligations. And what happens 9 times out of 10 is that these companies end up throwing in the towel and taking the company to market and selling out to a strategic buyer or possibly a private equity buyer. In most of those cases, the upside for the employees in the future is shortchanged. They just lose out on the future upside and the future cash on cash returns, frankly, that are available in private enterprise in the US. And I think it's a shame. I think we should do more to help these companies preserve the employee ownership, at least to a certain extent, and make it work within the capital structure that they have. So you may have heard about private capital coming in theory. We all know it's possible using the drop-down LLC structure, which is a separate talk in and of itself. But nevertheless, I think a lot of people in the marketplace are aware that this opportunity is available, but I've actually seen it firsthand working to drive value creation and outcomes for investors, for employee owners, for management teams, and boards of directors. So I can tell you that it does work. And what we're going to do is talk about a case study where private capital came in to do exactly that. So the case study I'm going to talk about is with a company that I have a relationship with that's in the professional services space. I'll keep it confidential for obvious reasons here, but they're in the people business, and the retention and motivation of their employees are critical and enter into the thinking on pretty much every decision that this company makes. It's a huge factor for their board of directors to consider as they think about capitalization, growth, and opportunities that lie ahead for them. We did 2 successive engagements with this client over several years, and one was really to set them up for success over the long term and sustainability. And the second was allow the employees to realize liquidity and diversification from the efforts that they had put in to build this great company. And so we're going to talk a bit, first about the initial engagement that we had. As good investment bankers, we came in and ran a bunch of diagnostics on the company, including the ESOP plan. And what we found was that the ESOP plan was in great shape. They had a great finance team. They had good advisors along the way. And they weren't really facing material repurchase obligations, even though sort of the equity value of the company had definitely gone up and to the right very materially over about a decade. So we got to boiling the ocean to figure out, what we might do with this company. And we quickly found that, like a lot of ESOP companies, they had put in place a stock appreciation rights plan, so a synthetic equity plan to give incremental upside to the key managers and executives, and in fact, to retain those folks through the transaction and for the decade that followed, so that they would, stay in their seat and continue to drive value creation for the enterprise. So we took a look at the stock appreciation rights plan and, looked again at many, many alternatives and decided at the end of the day that the best alternative for them was to terminate the SARS plan altogether, which might seem a bit antithetical, but rest assured that we had a plan for what to do after the fact. And the idea was that we would terminate the plan in its entirety, trigger a payout of the plan at the valuation that the company had currently on the stock, use a very simple senior debt structure to be prepared to pay it out. But really what we wanted to do was get rollover and get buy-in from the key executives and the partners. So we gave them a very strong incentive in the form of a profits interest. So they rolled their stock, or their SARs, I should say, over into a capital interest. And then we gave them an incremental profits interest to make sure that their equity ownership position in the capital stack just didn't change from yesterday to today with the recapitalization that we did. So there's no more synthetic equity. The executive team owns real, actual equity in the firm. And talk about getting a chance to see the hearts and minds of your key managers. This gave the executive team an opportunity to see where the partners were and how much of them really wanted to roll over into the deal. We got a very significant rollover into that transaction. Of course, we had a strong, incentive. It wasn't, it was sort of the carrot and the stick, but the stick was never going to be used. We gave them a good reason to roll into the structure. The nice thing about the new ownership model is it allowed them to stay in the structure indefinitely and gave them an opportunity to continue to see that value creation over a long period of time, as opposed to a stock appreciation right, which had a very prescriptive payout mechanism. It wasn't really a call right. It was just a fact that it was on a prescripted date, needed to be paid out per sort of the IRS regulations. So completed that transaction, terminated the plan. Well, it might seem on the face of it that we're taking something away from people. Not at all. We replaced it with this new plan, and it went over quite well. And what that transaction really did for the company, of course, it allowed them to avoid having the big payouts that I had mentioned earlier over the next 3 years, but it gave them an opportunity really to think about growth and think about ways in which to deploy capital in the future. And it gave, the executive team, real ownership and real buy-in in the firm, and set them up for sort of a step 2 transaction. So that was, step 1, kind of in a nutshell, in terms of what we did there. We preserved the employee ownership. We just did it in a different way. And then moving on to step 2, I call this sort of the realization phase. It's really realization and diversification. So given that step 1 was successful and set them up well, I think the management team and the board and the executive team came to the conclusion, after pursuing organic growth and M&A sort of on their own, using their senior debt capacity, as limited, because they didn't really have a third-party capital provider to come in and help support that with incremental capital. The company was very sort of averse to using all of its debt capacity, like many ESOPs, to go out and do what is sort of a risky M&A strategy. So they brought in a capital partner. The capital partner allowed them to provide an opportunity for the employees to diversify their holdings. And so they got part cash, part stock in the transaction. And within the ESOP plan, what we did there that was super interesting is, instead of continuing on in a traditional ESOP, the ERISA, structure that we all know and love, we actually terminated that plan and provided a liquidity mechanism for folks to diversify their holdings and roll over into an IRA, or they could continue to own stock in the company. And so we did an internal market to allow these ESOP participants to subscribe to incremental capital within what really was an LBO. We had a traditional, senior debt, leverage transaction coming on on board with the company's capital structure. We had a pref piece, and we had new common coming in from the investors. So it was kind of a traditional LBO, and we allowed the ESOP participants the opportunity to roll over into that and subscribe to it. So during that subscription process, you're again just getting a laser focus into the hearts and minds of the participants in terms of what they think about the next phase of growth and the new capitalization of the entity. And we were multiple times oversubscribed on that transaction, within the ESOP. The ESOP was terminated. It was turned into a company stock fund. The reason we did that is because you might ask, okay, you've done all of this, but the crux of the matter with ESOPs is that they end up having significant repurchase obligations, which oftentimes cripple these ESOP companies from being able to go out and do growth and other value creation strategies. Well, in this case, we set up an internal market within the 401k plan. And we said, look, if folks want to put their shares, or if they become eligible to put their shares, they can do that. And then there should be enough demand within the 401k plan with cash assets to buy out that stock. We did the exact same thing on the partner side, where we have the ownership units, and created an internal market for the partners to buy each other out. So if certain partners were ready to take liquidity and go into retirement, or what have you, or just diversify their holdings, they could put shares in and have those shares bought out. And so it really gave an opportunity for people to control their own destiny, which is probably one of the knocks on being in an ESOP structure, because you can only, of course, put the shares really upon retirement. There's other ways in which you can do it, but the reality is the vast majority of the liquidity that you take and the diversification that you get is sort of at time of retirement. So what is the prologue on this company? I mean, it's still being written. This is a thriving company who you may have come across in the marketplace, but they're owned today in a partnership model. They've got a new financial partner, call it a private equity investor, that put 50% of the common into the company, and the management team next to the ESOP owned the other 50%. And so it's still employee owned. They were able to preserve their culture. They were able to preserve their values. And in fact, one of their values is to grow the firm and continue to, accelerate that value accretion. Fundamentally, this company came to a point where they had accelerated the value accretion on their own for a long period of time. And just from the law of numbers, they got very large. And then it became a point where they needed help, if you will, in the form of a new partner to take it to the next level. So the company today, as we sit, is poised for accelerated growth. They have a fantastic equity partner. They've got a pref provider. They've got sort of all the elements that they need to do M&A and do it successfully. And the repurchase obligations that exist from the employee ownership model have been addressed and dealt with. And we weren't able to take them to zero, just to be clear, but we were able to significantly reduce and mitigate those repurchase obligations so that the health of the enterprise is first and foremost in the objectives of this company and its board. So we really do think we got a win-win-win. And when I say that, from the employee perspective, you got to take some chips off the table and diversify your holdings and create, incredible wealth for yourself and for your family, and then roll into the next phase of growth and have an opportunity for good returns there. For the management team, you got really buy-in from everybody, from all the way down to the rank and file up to, the CEO himself. You knew exactly where everybody stood relative to how much, am I going to roll into this deal, and how much do I believe in this company and what we're doing in the marketplace for the next, 5, 10, 15 years. So you get like vision into the hearts and minds of your employees, which I think is just great. And from the investor's perspective, of course, they care about all that stuff that I just talked about. They want alignment with the employees on rowing the boat and driving value creation at the firm, no doubt about it. But they will have an opportunity as well for significant returns in owning this company, because it's well positioned in the marketplace and it's a high quality company, notwithstanding the fact that it had been in the ESOP structure for the last decade. And I do think that, of course, the employee ownership model helped this company become what it is today. So with that, I'm going to conclude my remarks, but I'm happy to chat about this anytime. So feel free to reach out to me. My email is very easy to remember. Again, my name is Mark Buchanan, and the email is mbuchanan@stout.com. So if you want to chat about this or anything else, give me a shout or give me an email, and we'll schedule a call to catch up sometime. So I hope you have found this insightful and useful, and enjoy the rest of the conference. Thank you very much.